The valuation of intangible assets. We are going to consider some general principles regarding how to evaluate intangible assets following the principles that are established by the academic field and the practitioners. This is taken from chapter 2 of my book, The Valuation of Digital Intangibles of Palgrave Macmillan. We can now start from an abstract looking also for the key concepts of intangibles. We can say that an intangible is a non-monetary asset that manifests itself by its economic properties. It does not have any physical substance, but it grants rights and economic benefits to its owner. And in particular, we can also say that intangibles are goods or items that can be replicated. Let's make an example. Let's say that today I buy a sandwich. This kind of good cannot be replicated. If I eat the sandwich, nobody else can do this at the same time. But if I look at a video, anybody can look at this intangible product simultaneously. And this is going also to affect the scalability of the intangible asset. In general, we can say that intangibles are more specific than other assets and incorporate also higher information asymmetries. So there is a higher risk profile and a lower collateral value. Whenever a firm that incorporates an intangibles goes on and passes from a going concern to a breakup value, then the residual value of the intangible is typically very limited. And in many cases, it is corresponding to zero. We also have to consider that the accounting framework of intangibles is very controversial, and it is going to privilege prudence over substance. As an example, I might record a cost for creating an intangible, research and development to create know-how or a patent. In most cases, the kind of costs are not going to be recorded in the balance sheet, not going to be capitalized, but just recorded in the income statement. And this is good for prudential reasons, but this is also not so good when I have to evaluate this kind of intangible and I'm looking for clues inside the balance sheet. The most widely used approaches of assessing intangibles, according to the International Valuation Standard 210 that we are about to see in the next slides, are based on market, income, or cost-related metrics. We might also consider hard-to-value intangibles that are based on innovative business models and whose value drivers are difficult to analyze and compare. We have already seen that intangibles represent an ongoing challenge for accountants, and intangible value is hidden in the balance sheet. This is due to inadequate accounting, but it is not the case in the income or in the cash flow statement, where the intangible contribution to profits can be detected. Intangibles are non-monetary assets with no physical form. They are immaterial. And so it is difficult to find a hard evidence for their existence. Intangible assets may be recorded as an asset in the balance sheet only if future economic benefits can be expected. But even in this case, according to the international accounting standards, the capitalization of intangibles is strictly limited to some residual cases. An intangible asset can be identified if it can be separated, if it is capable of being separated and sold, transferred, licensed, rented, or exchanged, either individually or together with a related contract, or if it arises from a contractual or other legal rights. The requirement for an intangible to be identifiable is included to distinguish the asset from the internal generated goodwill that can never be recorded. This is according not only to the international accounting standards, but also to national accounting standards in any Western country. This is due again for prudentiality reasons. And according to Baruch Lev, who is a distinguished professor of NYU, most of the strategic value-creating resources of business firms, such as patents, IT, brands, are currently expensed and therefore not recognized as assets in the financial reports. They are just recorded in the profit and loss account in the income statement. And thereby, this is understating the earnings of intangible rich firms. And on the other side, this is also overstating the earnings of intangible declining firms. There is a fundamental inconsistency between the accounting treatment of internal generated intangibles, which are expensed, which are recorded, as we said, only in the income statement, and that of other capitalized intangibles that might be recorded in the balance sheet according to some strict accounting rules. For all these reasons, the disclosure of intangible expenditures in financial reports is very difficult, is seriously deficient. Except for R&D, all other intangible expenditures are generally aggregated within large expense items, and they are very difficult to detect inside. Also, this slide gives us a representation of the analysis of the intangibles for valuation purposes, starting from functional analysis. Functional analysis is related mostly to transfer pricing regulation, especially within the OECD transfer pricing guidelines. We can start from functional analysis that is going to detect the role of intangibles, even using comparables and an industry or market survey. Then we can go to a business planning. So the functional analysis is going to explain how the business plan works. And eventually, we use business planning metrics with economic and financial strategic drivers to assess the value of the firm that includes the intangibles. From the firm, we can have bottom-up feedbacks, and from functional analysis to business planning and eventually to firm valuation, we can have a top-down approach. Also, we have now here a sort of quite technical slide about valuation drivers and main methodologies of the valuation of the appraisal of the intangibles. Capitalized intangibles are part of the CapEx, capital expenditure, and so they are part of assets recorded within the fixed assets in the balance sheet. Intangible costs are normally part of the monetary OpEx, monetary operating expenditure. Amortization, that is another component of intangibles, is a non-monetary OpEx, because whenever I amortize the value of, for example, a patent, I don't have any cash out, any decrease in my liquidity. So this is a non-monetary cost. There are two most common valuation approaches for the evaluation of firms, and they are based on discounted cash flows. Operating cash flows are discounted at the weighted average cost of capital. Net cash flows belonging to shareholders are discounted at the cost of equity. Or we can use market multipliers, for instance, using the earning before interest, taxes, depreciation, and amortization, times a multiple of comparable firms. The EBITDA is at the same time an economic margin, but also a financial margin. And that is why it is so useful in business valuation. This EBITDA indicates the cash that I am able to produce within my income statement. There is this kind of formulation here reported in red, which is the enterprise value. An enterprise value is the value of the whole company, including debt. It can be given by, as we said, operating cash flows divided by the weighted average cost of capital, but operating cash flows can also be the algebraic sum of sales less monetary OPEX, and this gives the EBITDA. Then I have to consider a change in the net working capital, in the net operating working capital. The working capital is given by the sum of the stock plus accounts receivable less accounts payable, and then I sum up the increase, if it is an increase, of the capex, of the capital expenditure. All this numerator of the ratio gives the operating cash flow that is going to be discounted accordingly with the weighted average cost of capital. So I have a sort of basic EBITDA plus an intangible driven component times a market multiplier. These are the two methodologies described above that are considered in a comprehensive way. Intangibles also impact on sales. There is a scalability effect on monetary OPEX because there is the cost of non-capitalized intangibles, and on the CAPEX whenever I can capitalize and record in the assets the value of the intangible. Here we have a small but important comprehensive picture that connects the balance sheet, the variations in the balance sheet with the income statement, matching these variations of the balance sheet, assets and liabilities with the income statement, I can get the cash flow statement. And I have different methodologies for the valuation of intangibles. The market value starting from the equity, a balance sheet based valuation, and also an income method with market prices, and a financial methodologies taken from the cash flow statement. So this is a general picture for the valuation. We can get most of the parameters that we are going to use in the valuation of the intangibles from our balance sheet, income statement, and cash flow statement. Then we can have, of course, also market comparables or other information from the outside of the firm. We also have, according to the OECD transfer pricing guidelines, the ones, as we said, related to functional analysis, we can have a distinction between commercial intangibles, patents, know-how, industrial designs, ornamental models, or the marketing intangibles, including trademarks or brands, even digital ones, trade names, customer lists, distribution channels, symbols, acronyms, or logos. We think of a logo of a mobile app, or unique names which have a promotional value. Then we have, and this is very important in the valuation, the International Valuation Standard 210, according to which an intangible asset is a non-monetary asset that is going to manifest itself by its economic properties. It does not have any physical substance. It is immaterial, but it grants rights and economic benefits to its owner. Again, the intangibles can be marketing related, customer related, artistic related, we think about copyright, contract related, or technology based. So this kind of definition is wider than the one reported above and considered by the OECD transfer pricing guidelines. Then we can have, again, according to the International Valuation Standard 210, three methodologies that we are going to use in the valuation of the intangibles: the income approach, the market approach, or the cost approach. We have in this slide a comprehensive evaluation of the three main methodologies. The market approach considers, for example, enterprise value divided by, again, the EBITDA. We consider the weighted average cost of capital, the cash flow statement, discounted cash flows, and then we have the cost approach linked to the income statement, to the operating leverage or the financial leverage. And then we have the income approach with relief from royalties, differential income. This is very important, which is the incremental value of the firm that belongs, that can be explained using intangibles. Let's say that a company without a patent is worth 100. The same company with the patent is worth 180. We might infer that the incremental value of the patent is around 80. We can have a price premium or other methodologies that we are going to see in the later slides. Let's consider now in a deeper detail the cost approach. According to the cost approach, the value of an intangible asset can be assessed by the sum of its capitalized costs. This approach does not consider neither maintenance cost nor the opportunity cost of time of deferring the use of the intangible. It is, however, a difficult method to implement. It is difficult, for example, to find costs incurred in the past, especially if they are very old. And also we might use either a replacement or a reproduction cost, which is the cost of replacing the intangibles, which is the cost of reproducing the intangible from scratch. We might think, as an example, about software, which is the cost of reproducing this kind of combined codes with algorithms from scratch. How much time does it take? Which is the working force of IT people that I need to employ to reach this kind of software? And this is also very important. The cost approach can give us some clues, but it is not, in most cases, the widest methodology to assess the value of intangibles. Then we can have the income or financial approach. Why do we consider together income and financial? Income derives from the income statement, from the economic profit and loss account. Financial from the cash flow statement. They have a common point, as we said before, represented by the earning before interest, taxes, depreciation, and amortization, which is, as we said, an economic but also a financial margin. So we have some similarities about incomes and cash flows. The income approach is based on past and future, especially future economic benefits that can be linked to an intangible. And this income approach essentially is going to convert future cash flows or income expenses to a discounted net present value. We can forecast future cash flows and discount them using a discount factor that is going to incorporate risk. For example, if the future cash flows are represented by operating cash flows before payment of debt, then we have to discount these cash flows using the weighted average cost of capital. We can also have some particular variants of this income financial approach. For instance, and this kind of methodology is very used, the relief from royalty approach. Let's say that I don't own a patent as a company. I have to rent it. Somebody has to give me a license over it. How much would I pay for it? This is a measure of the value of the patent. Then we can have a second one represented by the with or without approach. Which is the value with or without the patent? As we said before in the example, the value of the firm with the patent is 180, without the patent is just 100. So the incremental value that can be attributed to the patent is 80. We can also have an excess earnings approach to be used in the estimate of the value of the intangible asset. It is the income that a firm would record if it was disposed of the ownership of all the other assets to regain the right to use them through licensing or rental contracts. We have other less used approaches, for instance, the greenfield approach using cash flow projections, the distributor approach similar to the relief from royalty approach. We might also use real options. Real options are often used in capital budgeting to make economic and financial forecasts more flexible. I can have an option to scale up a project, to suspend it, to abandon it. I can use real options, for instance with patents, to evaluate flexible investment projects with uncertain outcomes. And they can be linked to scalable investments. I can also discount the differential income or the cash flows. The market approach is a third one, is going to consider the prices generated by market transactions involving comparable assets. And this is not easy to understand. If my intangible is very particular, then it is also difficult to compare it with similar ones. If I have a very strange, very complicated patent, how can I make a comparison with similar patents? This is not an easy task. And we have a reminder from in the International Accounting Standards 38, according to which an active market cannot exist for brands, newspaper mastheads, music and film publishing rights, patents or trademarks, because each such asset is unique. Unicity is a factor of strength, also a weakness. If it is unique, then the intangible asset is difficult to compare. When this market approach is applicable, it is based on the comparison with similar assets. But also this is going to incorporate some, again, information asymmetries. We can have within the market approach, again, an empirical approach. The income can be attributed to the exploitation of a given intangible asset. We can evaluate the differential assets, for example, using the Q of Tobin, a Nobel Prize, according to which the Q of Tobin is related to the market value of an asset divided by the book value. If the ratio is higher than 1, it means that it has an added value, an implicit goodwill that can be attributed to the intangible asset, for instance. So let's say that a company with a patent has a book value of equity of 100, and the market value of equity is again, like in the previous example, 180. So the Tobin Q is 1.8, and this is a good clue to estimate the value of the patent within the company. Again, we have also a similar price book value index that can be used as a market approach. Intangibles, and this is very important in the evaluation, can have a defined or indefinite useful life. Useful means a life during which they can produce value. For example, we have a definite useful life for patents, typically no more than 20 years, where the trademarks never expire. They just need to be renewed from time to time. The patent of aspirin has expired more than a century ago. The trademark of Coca-Cola is still there. We can have a defined useful life subject to systematic amortization and a following estimate of the residual useful life, or we can have an indefinite useful life with an impairment test, for instance of goodwill. Many intangibles have a limited useful life, and so we have the warnings according to the OECD transfer pricing guidelines that we should remember in this kind of assessment of the difference between short living and indefinite living intangibles. We have even a particular kind of intangibles that are called surplus intangible assets. They indicate, for instance, ancillary capital, which is going to express the current value of assets that are not relevant to the performance of the operating activities, and they are not instrumental to the company's operations. They are ancillary. We can have components that are going to be subject to an independent valuation, and these elements may include intangibles or surplus assets that are included in adjusted balance sheet based approaches, evaluation approaches that are based on the balance sheet, on the book value of equity, and then they consider an incremental value given by these surplus assets, or can be estimated with a mixed capital income approach, combining the balance sheet based approach with an income approach. We also have, for example, they are quoted many times in a template in a project by the OECD again, how to value intangibles. Intangibles that are so peculiar, so strange, so sophisticated that they are difficult to define, and in many cases they become hard to value, especially if they're not patented or branded. Comparability is very difficult. According to the OECD guidelines, the term hard to value intangibles covers intangibles for which there are no reliable comparables. The projections of future cash flows are very difficult, and so it is not easy to assess the value of this kind of intangibles. Transactions involving how to value intangibles may be difficult because the intangible is only partially developed, is not expected to be exploited commercially at that very time, is expected to be exploited in a manner that is novel, and so there is no benchmark for this kind of valuation. That's why this kind of intangibles are typically hard to value. Eventually, at the very end of our presentation, we can make a short reference to the resource-based view. This kind of view, this managerial and strategic theory, is based on the importance of the internal variables for an organization compared to the external ones. For the resource-based view, intangible resources and human resources are the most important because they are rare, complex, difficult to manage, and also difficult to imitate from the outside. They are a source of the competitive advantage because they give greater efficiency, and also they can coincide with knowledge, innovation, access to information, corporate identity, customer loyalty, when clients are stick to the company and to its products, relations with stakeholders, professionalism, and motivation of human resources. We can also have this kind of resources linked to capabilities, competitive advantage given by unique competencies, sustainability, opportunism, timing, and appropriability. And then we can have a difference between tangible and intangible assets. Should you want to learn more about these issues, you might consider chapter 2 of this book that is dedicated to the evaluation of the intangibles in a general way.